Welcome to Term Life Insurance Options. My name's Glenn Cook and I'm the term guy. In this video, we're going to drill down on differences in options and features available in some term policies and not others. These are the differences that make term life insurance different from company to company. So the first four policy provisions are available. When they are available, are for free. You don't have to pay anything for them. And importantly, these policy provisions are sometimes available in the cheapest policies available in Canada and not available in some of the more expensive ones. You can't tell based upon price whether or not these policies have these four features. The first two are renewable and convertible. And let me stop and emphasize this. You should always make sure that your term life insurance policy is renewable and convertible. Do not take a non-renewable, non-convertible term policy unless you have no other choice. These are the most important features. They're vital in a term life insurance policy. And let me tell you what they are. So if you purchase a non-renewable, non-convertible term policy, let's say you're 40, you purchase a 20-year term. Now you're 60, so we fast forward 20 years, your coverage is over. It's done, you're out of life insurance. And if you've become uninsurable over the last 20 years, you've got a real problem because you can't get any more life insurance and your current policy is done with no ability to get more life insurance. If your policy is renewable and convertible, the policy actually continues on at a higher premium. It's not ideal. You can cancel it, but it continues on at a higher premium. That's the renewable part. The convertible part says you can actually send it back to the insurance company and they will give you back in its place a brand new permanent life insurance policy, level premiums for the rest of your life, and no questions asked. They're going to use the health class you got back when you were 40, 20 years ago, which was probably standard. Which means if your policy is renewable and convertible, you purchase it at 40, now you're 60 and you've just had a heart attack. If your policy is not renewable and convertible, you're done. If it's renewable and convertible, you can just send it back and say, give me a lifetime policy, no questions asked. Now, this is important. When we purchase the policy, again, let's say at age 40, we don't care about this, but you have to make sure the policy is there when you buy it because you're not going to care until you're 60. When we're 40, everybody's healthy, they've passed their medical exam and they have their term policy. But over the course of the next 20 years, we split into three groups. The first group are the people that died during the course of the 20 years and they got their death benefit and they're out of the group. The second group are the people we expect to be, which are now we're 60, we're healthy, but we don't need the term life insurance anymore, so we just cancel it. We're done. That was the plan. But there's a third group that you could get slotted into, and that's the group that became uninsurable from ages 40 to 60 or whatever the 20-year age group was. The people that have had heart attacks or cancer or developed some other condition that says you're never getting life insurance again. Now you're 60. If your policy is not renewable and convertible, you're out of life insurance. If your policy is renewable and convertible, you just send it back to the company and say, please give me back a lifetime policy with level premiums, and you don't get to ask any questions and you have to give me healthy rates. It's crazy that life insurance companies do this. And when they do it, it's available for free and it's available on some of the most competitive policies in Canada. Make sure your policy is renewable and convertible. The third benefit is called accelerated death benefits. Accelerated death benefits say if you have limited mortality, generally less than a year, they will let you access a percentage of your death benefits while you're still alive. And then when they do pay the death benefit, they just deduct that amount from the coverage that they're going to pay out. The exchange option is like the conversion option. So the exchange option is the fourth one that's available for free. It says you can exchange your term policy for a longer term policy in the first 5 years of the policy. So if you're budget sensitive and you want a 20-year term, but you don't have the budget for it, you can take a 10-year term, fix your budget concerns in the first 5 years, send it back the 10-year term in, and they'll give you a brand new 20-year term at that time. Again, renewable, convertible, accelerated death benefits, and the exchange option are all available for free when they're available. The next three are riders. These are options you select and there's an additional charge for them. The first one is accidental death. It says if you die as a result of an accident, we pay more money. So you might get $1 million of coverage and top it up with a $200,000 accidental death benefit rider, add an additional premium for that benefit. I've never seen a situation where you need more insurance depending upon how you died. If you die as a result of a heart attack or in a car accident, you need the same amount of insurance. Therefore, hard no on accidental death benefit. Just make sure you have enough coverage and skip the accidental death. Then the next rider is called disability waiver of premium. It says if you're completely disabled, the insurance company after 6 or 9 months will pay your life insurance premiums for you. Almost a good idea, but in practice, what you really should have is a comprehensive long-term disability policy that covers all of your income so that if you become disabled, you can pay all your bills, including your life insurance premiums and your hydro and your gas and your groceries. So that's the correct way to cover disability, is a long-term disability policy, not nickel and diming through your life insurance policy. The last one is children's protection rider. So what a children's protection rider does is covers all your children for a small amount of life insurance at a very small premium. And I'm going to use the policies we have on the termguide.ca as an example. So if you select children's protection rider, it's $10.80 per month, and it covers all of your children for $20,000 of life insurance coverage while they're children. Now, when they're adults, it terminates, but you do have the option to exchange it when that happens for a permanent policy, which would be the case. You would do this if your children became uninsurable until before they were an adult. You're going to say, well, I don't want them to have no life insurance. I've got the children's rider. I can exchange this rider now that they're an adult for their own individual permanent policy. The last two policy provisions, they're not options. They're in every single life insurance policy, but it's important that you're aware of them. These are the loopholes insurance companies can use to not pay your death benefit. So you pass away, you've got $1 million of term life insurance. They're going to write the check for $1 million and say, here's your $1 million, except for two things. The first provision is called the suicide exclusion clause, and it says if you die by suicide in the first 2 years, they're not going to pay the coverage. The second one's a lot more nefarious. It's called the incontestability clause, and if you read it, it's going to say something like in the first 2 years of the policy, if you fail to disclose information, they can deny the claim, and after that, it's only due to fraud. Don't believe what you read. You're going to get the wrong idea from the wording. In practice, what the incontestability clause says is, when you applied for life insurance, doesn't matter how long ago that was, if you fail to disclose information, they can deny the claim. And it doesn't matter if the information you failed to disclose was because you didn't think it was relevant. It doesn't matter if it's related to how you died. And it doesn't matter if you did it intentionally or maliciously. It's just the fact that the information wasn't there. So how do you protect yourself against that? Real simple. When you do the medical history interview, when you do your medical questions on the phone with the insurance company, listen to the questions and tell them everything. And then if you pass away, the insurance company is going to say, here's our $1 million. Was it suicide in the first 2 years? No, it wasn't. Did you fail to disclose anything? And they're open your file and go, no, this person told us everything. There is no other loophole. Your policy is rock solid. They're going to pay the claim typically within days. So there you have it. Those are all the important options, riders, and features inherent in term life insurance policies. Now you can compare different policies to find the best one that's for you based upon a similar premium comparison.